Greetings, Keith Prather there, here with NCM, and this is the Power Sports Economic Outlook. So we're going to start with the demand index, and right now the demand index is kind of interesting. It is showing a pretty good environment overall for power sports. I know some of you aren't feeling necessarily that kind of demand in your specific market, but the January index came in at 88, a little bit weaker than we saw in January or in December. That's a little bit of seasonality in there. There were incentives at the end of the year that kind of pulled people into dealerships. And then January had a bunch of bad weather. There were a lot of factors that kind of pulled it down. Now, year over year, still 7% higher than it was a year ago. And, it's coming off of a period where we did have a little bit of troughing taking place. So the market was down from where it was, in 2023. So that gap may look a little more dramatic than normal, but overall, the demand index is still showing historically pretty significant demand. Again, this is like a leading index. It looks out over the next 5 to 6 months and just gives us a general idea of kind of what the market is going to look like and what that demand environment looks like. The other thing that we do for you is we are able to pull some power sports retail data, and some of the most recent retail data still shows, again, that swooning that we got in January. So 3% lower month over month, a little bit lower than our demand index. Again, the demand index is going to tell us sort of what the potential is. The actual retail sales index will also, take into account things like higher interest rates or some of those items that may actually make sales underperform what expectations are. But it was still up almost 7% year over year. So again, kind of right in line with the index that I showed you prior and where we were from last year. And we're still running about 0.4% higher over the 3 month moving average. So, not that exciting, if you will, on the 3 month average, but we still like the fact that it's still running a lot hotter than it was a year ago. So looking forward, again, I have this on a lot of the videos this month, but there is one big macro trend that we're watching. There's actually a couple, but this is the biggest one. The Trump administration is trying to shift spending. So we're going through a transition period, and we all know this. Consumer spending has still been strong. So even coming out of Q4, it was running almost 82% of GDP. Normal for it is about 73%. So running a little bit hotter than normal, which is fantastic, right? That's helping drive, some of the power sports spending. It's part of what's driving the industry. It's part of what's helping. But government spending was running about 18% of GDP. That's a lot hotter than it should be. We should be down around 12 to 13% of spending. So they've got to get it under control. We know that. That's what the whole Doge effort is all about. We've got a lot of different efforts to try and work on trimming government spending. I mean, the Trump administration is shooting for about $1 trillion in trimming. That's about 250,000 workers that are probably going to get laid off from the federal government when all is said and done. And they're trying to front load this. They're trying to get all the pain and suffering out of the way early on in this first year. Now, what they're trying to do at the same time, though, that they cut government spending and cut some of that money moving through the economy, is they're trying to shift it down into residential fixed investment and non-residential fixed investment. Just said simply, they want consumers buying homes, cars, power sports equipment. They want them out spending money, and they're trying to create the incentives either through lower interest rates or a better job environment, better wage environment to try and drive that spending. At the corporate level, which is this figure, they're also trying to spur corporate investment in spending, in automation, in expanding facilities, in reshoring, a lot of construction activity, a lot of manufacturing activity. They're trying to get a lot of that spending driven by private corporate decision making. So it's the right direction. It's just a lot happening all at once, and it creates a bit of chaos, right? It impacts optimism. Everyone's concerned because we don't see the data yet to know how these first 35 days are going to impact the economy. And it's really early. Again, just 35 days in, and a lot has happened already. So we're all trying to digest that, and there's a little bit of confusion in the market, but that will straighten out. It will get better over the first half of the year. At least we'll be clearer on actually what the impacts are, whether good or bad. We're going to be clearer on them. So Q1, which is what this is showing, was still trending at about 2.3% growth, which is pretty good. That's ahead of 1.3% in 2024. So we're optimistic about that. But that transition period is a big uncertainty for us, and that's what we're really focused on, and that's what we're concerned about. So a couple things about the industry. So we're learning that in especially this sector, interest rate sensitivity is really high. So for every 50 basis point cuts in interest rates, so we think in 2025, the Federal Reserve is going to do at least two 25 basis point cuts. We may see 250 basis point cuts depending on what happens with inflation and depending on, what the Fed is looking at. Last year, their forecast for 25 is that we would get another full 100 basis points in cuts in 25. So we'll see what happens. But for every 50 basis point cuts in interest rates, it boosts sales by 1.8% for new units and about 4% for used sales. So again, if we get a quarter point cut, you can get almost 1% increase in the forecast for new sales, and we'll get about 2.1% increase in used sales activity. The one thing that we are watching also is delinquency rates are still pretty high for Gen Z buyers. And we'll see what happens. There's some risk growing under Doge and other tightening that's taking place. But in general, it should help overall with power sports. One of the things that's a little bit unexpected for us is that Doge and that trimming of government workers is also being offset by the push to get workers back in the office. For every one government employee being cut right now, 9 are being forced back into the office. If you look at the commuting traffic maps right now, like especially around heavy government areas like Virginia, Washington, D.C., and a couple of other markets, you can see commuting rates up almost 100% over where they were, last year at this time. And you're seeing really significant increases in commuter traffic in other markets, like areas like around Amazon or Microsoft facilities, places where you've got heavy labor volumes going to a single company, and that company has enforced a back to the office doctrine, if you will. So again, Seattle and some of those markets that are a little bit unexpected, you see that back to the office trend. And so they're out buying a lot of different types of vehicles, and some of that will fall in the power sports category. Anything that helps with commuting, you're talking about motorcycles and some of the electric vehicles, scooters, a lot of that, we see a lot of increases in demand and traffic in those markets. So watch for that because that could be a positive driver of growth coming out of the Doge effort. So ATV, UTV expected to grow about 6% this year. Overland trends and the enthusiast side of things is really where a lot of the biggest growth is. So that's going to drive about 40 to 45% of all side-by-side sales. Farming, I was surprised, but farming is just about 15 to 20% of overall side-by-side sales. And we would consider hunting and, fishing and, some of the enthusiast side of it to be part of this overlanding. So it's just interesting, and that's going to continue to be a good market. Tariff impacts, we think, again, primarily because of the impacts on steel and aluminum, also some on electrical equipment, could push prices up to 12 to 18% overall, depending on sort of the offset of currency exchange rates. I know that's a mouthful, but let me give you an example of kind of how that works. So let's take a $100 item being bought in from China. Today, the Trump administration is going to apply a brand new 10% tariff on that $100 item. So that pushes the cost of that item up to $110. Now, the way China and other countries fight back against that is they devalue their currency. And when they devalue their currency, the last time China devalued their currency almost 10% against the dollar. So that item, again, that $100 item now with a devalued currency of 10%, makes it a $90 item. And then when you apply the 10% tariff to that, it makes it $99. So that difference may null and void a lot of the tariff risk on some of these products. The other thing is that in the 2018 to 2019 period, the Trump administration issued about 18,000 tariff exclusions on a lot of the products that we import. And, so it also it dulled a little bit the total impact of those tariffs at the time. So we've got a lot of things. There's still a lot of moving parts. We know we'll get the first decision on Mexico and Canada sometime next week, early March at the time of recording. And then we won't get other tariff decisions and then probably April 1st, about another month after that. So watch for a lot of moving parts here. I think by the next month, by the next update, we'll have a little clearer picture on what's actually going on. So GDP grew about 2.7% in 24. We believe for 25, the Federal Reserve believes it's going to be about 2.1%. The Trump administration, and we've got a really good Treasury Secretary in place now, Scott Bessent, and Scott has done analysis, and I've listened to it. He believes that we're going to be closer to 3% by the end of the year. We'll see what happens. I do think this transition period between, trimming government spending and then the transition into creating incentives for the private sector to spend and invest and grow is a little more sluggish than I think what they had believed it would be. And so I don't know if we'll hit 3% this year, but hitting closer to last year's growth rate, entirely possible. And again, remember, pockets of this industry are going to grow at 6 or 7%. So you've got a pretty good environment ahead. The unemployment rate inches up just a little bit this year from where it was last year. A lot of that again will be government employees, and then some of the industries that feed off of government contracts. So that's where that comes from. Inflation is going to be fairly stable. The Fed funds rate, again, we still expect the Federal Reserve to at least cut by 50 basis points this year. Maybe you get another 50 next year. That's probably where the prevailing sentiment is, and you can see that reflected in the forecast here. So overall, still a really good, strong market environment, I believe. There's going to be some sluggishness out there, we know, and we can't help that. I mean, we're going to have to work our way through it. But again, a lot of it will depend on how smooth that transition goes from cutting government spending to spurring investment in the private sector and the growth in the private sector overall. So hope everyone stays safe, and we'll see you next month. All right, take care.